Yeah, absolutely, Scott. And that's the beautiful thing about stock markets. They can get a life of their own and run on momentum, which I think we're seeing here this week and out of the gate, which is wonderful. I mean, the service PMI number was good. The CPI was good. Everything we wanted to see. Wage prices were coming down. That's not going to cause the Fed to stop raising rates. They're still going to raise rates at the next meeting. It's not going to accelerate a pivot because we're so far away from it. So as good as this week has been, as good as the start to the year for 2 weeks have been, I just think we may want to temper a little bit of that enthusiasm and just slow the roll a little bit here.
What if we think that a pause is coming? Forget the pivot, and maybe the pause is a pivot, right? You get 25 next meeting, you get 25 after that, and because inflation's doing what it is, and some would suggest it's falling even faster than the Fed would acknowledge or is showing up in the actual CPI data, that's good enough, that a pause is good enough.
So let's play that scenario out, because I think that can happen. I think we could have 2 more 25 basis point hikes and certainly a pause. But we're going to stay data dependent. This Fed last year absolutely was data dependent. They told us maybe there'd be 2 rate hikes in 2022. But when they saw CPI going up like crazy, they reacted to it. Now rates are at 4.6, which is a lot higher than they thought. What they're telling us they're going to do now is they're going to run this thing up over 5%, 5.25%, and they're going to keep it there for a long time. Well, the good news is that, the data dependency will still be a reality in 2023. So I definitely see a scenario where that could play out, where you're getting the pause that we're looking for. But a pause isn't a pivot. A pause is good. It's exciting. But if they're wrong and they have to reignite the engine, we're back in that pickle of inflation. A pivot is when they push us too far. Maybe we go into that probable recession, and they've got to be accommodative to help get us out of it. And the bond market's saying that will happen this year. The Fed's saying it's going to happen next year. We'll see who's right.
So I think the last time we spoke, and I'm trying to remember correctly, and you correct me if I'm wrong, I think you told me you have about 13% cash, which is much higher than you normally would. Is that true? And are you swayed at all to start putting some of that money back into stocks?
Yeah, we have 11%, Scott, so we have been nuancing back into the markets, but we're always doing something. And I think this is a great lesson that investors can learn from us, which is it's all nuance and risk management. So on Friday of last week, we trimmed our Merck position. It's one of our favorite stocks. We love healthcare, but it's been doing so well that we took some profit there. We still own 5%, but we allocated some of that money into Amgen. We actually bought some Apple last Friday at 126. Your memory's better than mine. You remember a couple months ago, we were selling it at 157 and 160, so it felt good to pick up a little bit more here at 126. We're using this opportunity to write covered calls. We've got 7 options written on the portfolio. We're bringing in great premiums. We added a little bit to Nucor this week. So even yesterday, we added to Schlumberger. So there's opportunities here, but we're just being really careful. We're remaining defensive, kind of keeping on the belt and the suspenders.
All right, you just rattled off a bunch of names. I want to go one by one for a change for right now. Apple, all right? Apple 126, you picked it up. I mean, here we are at 134. We're a few weeks ahead of earnings for Apple. I mean, what do you really think about this stock's direction in the next, let's call it a couple of months?
Yeah, well, it's lower. I mean, for the next couple of months, it's going to be tough. I think the markets are going to be down, but I want to keep picking it up on that weakness. We like the stock. The multiple's still a little bit higher on Apple than they are on some of our other names. But I wouldn't look at this as a new trajectory into Apple hitting a new stratosphere. But we have 2% position now. We're just slowly building it on pullbacks. We'll continue to do it. The best thing about my thesis is if I'm wrong, we're equity investors, we're active managers. We benefit from all of these markets in these days that go up. But I'd still look at it the way I'm doing, in a nuanced, slow, and careful way.